A 35-year-old buying $500,000 of whole life insurance pays about $505 a month. The exact same person can buy the exact same death benefit as term insurance for about $35 a month. That is a gap of roughly $470 every single month. And in the first year, almost all of the extra money you handed over did not go into your savings. It went into your agent's commission. We did the math on where that money actually goes and on whether the famous strategy, buy term and invest the difference, really wins. The answer is yes, and it is not close. Here's the question we are answering today. When you buy whole life insurance, you are buying two things bundled together: pure protection and a low-return savings account with a large sales commission baked in. The pitch is that whole life is forced savings, a disciplined way to build cash value you can count on. So the real math question is simple. If you instead buy cheap term insurance and invest the premium difference yourself, can that invested money outgrow whole life's internal return? To answer it, we are using long-run stock market data going back to 1928, actuarial lapse studies from the industry's own research bodies, regulatory commission caps, and illustrative premium quotes for a healthy non-smoker. A quick note on the numbers: the structural math, the cost multiple, the commission load, the lapse curve, that is stable and evergreen. The specific dollar premiums vary by carrier and health class, so treat them as representative ranges, not a personal quote. Let's walk through it. Let's start with the raw cost, because the premium gap is the whole ballgame. For a healthy non-smoking man around age 30 to 35, a $500,000 term policy lasting 20 to 30 years runs about $30 to $40 a month. For a woman the same age, it is even cheaper, about $23 to $30 a month. Now put whole life next to it. The same $500,000 of coverage in a whole life policy for a 35-year-old costs roughly $450 to $505 a month. Call it $5,400 to $6,060 a year. Across the market, whole life premiums run 5 to 15 times more than comparable term for the identical death benefit. Let's lock in one clean example to follow for the rest of the video. Term at about $35 a month, whole life at about $475 a month. That leaves roughly $440 a month, about $5,280 a year, that the buy term strategy gets to invest. Hold on to that number. Now here is where it gets interesting, and this is the single most revealing fact in the entire video. When you pay that first year of whole life premium, where does it go? The first year commission on a whole life policy is roughly 70 to 110% of the first year's premium. New York State actually caps it at 99%. So on a $6,000 annual premium, the agent can earn somewhere between $4,200 and $6,600 in year one. Look at what that means. Your entire first year of so-called savings is paid out as the sales cost. That is exactly why, when you open a whole life illustration, the cash value in year one is often close to $0. People assume that is a glitch or a fee they will earn back quickly. It is not a glitch. It is the design. You are prepaying the commission out of your own cash value. The negative early return is not an accident. It is the structure. So what return does whole life actually deliver once you get past that brutal first year? The internal rate of return on the cash value is structurally low and backloaded. For roughly the first 5 to 10 years, the IRR is negative. If you surrender before about year 5, you generally lose money outright. After that, it slowly drifts upward. And for a properly structured policy held 20 to 30 years or more, it lands around 4 to 4.5% tax-deferred. Some long-run averages get quoted as high as 5 to 7%, but the honest, contemporary figure for a policy you actually hold is closer to 4 to 5%. And notice the shape of that line. It is flat or negative for years, and only the people who hold for decades ever reach the good part. That return ceiling is much closer to a bond than to a stock, but with worse liquidity and a giant upfront cost attached. Now let's put the alternative on screen. The S&P 500 has returned about 9.98% compound annual growth since 1928. Over the last 30 years, it is about 10.4%. Over a full century, about 10.6%. Adjust for inflation, and you are left with a real return of roughly 6 to 7%. Let's be scrupulously fair here, because the industry has two valid objections. First, whole life quotes its return net of fees, while stocks are often quoted gross, fine. Subtract the expense ratio of a low-cost index fund, which is about 0.03 to 0.20%, and the stock return barely moves. Second, whole life's return is tax-advantaged, true, but buy term and invest the difference can use a Roth IRA, a 401k, or an HSA, accounts that also shelter the growth from tax. Once you put the side fund inside a tax-advantaged account, most of whole life's tax edge simply disappears. Even after every fair adjustment, you are comparing about 4 to 5% against roughly 7% real, and that gap compounds for decades. Let's run the actual race. Age 35, the example we have been building. You invest the difference, about $440 a month, roughly $5,280 a year, in a low-cost index fund. At 7% net for 30 years, that side fund grows to roughly $500,000. And remember, you held a $500,000 term death benefit the entire time you were building it. Now, the whole life policy, funded by the same total premium, typically shows a cash value somewhere around $250,000 to $320,000 at the 30-year mark, consistent with that 4% internal return. So the side fund wins by something like $150,000 to $200,000 or more. And these side fund and cash value figures are illustrative models, not quotes, but the direction is rock solid. Here is the part that should end the debate. We can ask, how low can the stock return go before whole life ties? Actuarial analysis of a 35-year-old finds the side fund only needs to beat a modest pre-tax rate, often in the 4 to 5% range, to come out ahead by life expectancy. That is a bar equities have cleared over essentially every long holding period in history. But the 4 to 5% internal return has a catch that quietly destroys the whole pitch, and almost no sales presentation shows you this chart. That return is only earned by the minority of people who hold the policy for 20 to 30 years. Most people do not. About 12% of whole life policies lapse in year 1, another 10% in year 2. About 15% are gone within 5 years. Zoom out to permanent policies broadly and it gets worse. Roughly 29% lapse within 3 years, and about 57% within 10 years. Let that land. More than half of permanent policies are surrendered or lapsed by year 10, which is right in the zone where the internal return is still climbing out of negative territory. And across the industry, about 88% of universal life and about 85% of term policies end with no death benefit ever paid. Roughly 70% of lapses are simple non-payment. So the typical buyer does not earn that nice backloaded 4 to 5%. They lock in the worst part of the curve, pay the full commission, and walk away with less than they put in. Forced savings only works if the force holds, and the data shows it frequently fails at maximum cost. Before we get to what you should actually do, let's kill 3 expensive misconceptions with numbers. Myth 1. You get the cash value and the death benefit. With most traditional whole life, you do not. Your beneficiaries receive only the death benefit, and the insurer keeps the cash value. To touch that cash value while you are alive, you have to surrender the policy or borrow against it and pay interest. Myth 2, term is throwing money away. Term is buying exactly what insurance is for, cheap protection for a defined window. The premium difference is not wasted. Under this strategy, it is redirected into assets you keep. Myth 3, level premiums make whole life cheaper in the long run. Whole life premiums are high for your entire life. Level term premiums are low for the term. The lifetime dollars poured into whole life dwarf what you pay for term. And the deepest myth that whole life is an investment. It is primarily insurance with a savings rider, and it is the single most expensive forced savings vehicle available. So here is your decision framework, based on your actual situation. If your death benefit need is finite, meaning you are covering kids, a mortgage, or your working years by level term for 20 to 30 years and invest the difference in a low-cost index fund inside a Roth IRA or a 401k. For the large majority of people, that is the default correct answer, and it is built around the disappearing need. By the time the term expires, the invested difference has become the self-insurance that makes coverage unnecessary. If you might not hold a policy for at least 20 years, never buy whole life. Early surrender is the worst financial outcome on the board, and the lapse statistics show most buyers land exactly there. If the only thing pulling you toward whole life is forced discipline, get the same force for free by automating your index fund contributions. No 100% first-year commission required. And there is one narrow case where permanent insurance can be justified. If you are already maxing out every tax-advantaged account and you have a genuinely permanent need, like estate tax liquidity, a lifelong dependent or special needs trust, or a business buy-sell agreement, then permanent coverage can make sense. Even then, look hard at guaranteed universal life instead of whole life for a lower cost. Match the product to the need, run your own difference, and put it to work. If this helped you see the numbers more clearly, hit like and subscribe so the next breakdown finds you. We will keep doing the math so you don't have to.